All right. So, hello everyone. Thank you very much for joining us on this very interesting webinar about funds, tokenization, technology, and state of the art of what's currently happening with all these asset managers moving on chain, all the world itself moving on chain. So, my name is Edwin, I'm the CEO and co-founder of Brickken, and I have the pleasure to have two very excellent guests today. So, for this webinar, which I will let them each introduce themselves. So, Matthew, why don't we start with you, just giving us a brief intro on who you are, where you work, and then we take it from there. Thank you.
Yeah, thanks, Edwin. First of all, thank you for the invite and very much looking forward to the discussion. I think it's going to be very interesting. Yeah, I'm Matt. I work with Franklin Templeton. I'm based in Singapore. I'm a global program manager for our digital assets team. So my role covers a lot of projects and initiatives across the digital asset space for Franklin Templeton, working with partners, clients on integrations with digital exchanges, blockchains, distribution platforms, also working with regulators in the region. So yeah, a host of different projects across our tokenized RWA offering.
Thank you. And now, please, Bas. Oh, Bas, you're on mute.
Hi everyone, I'm Basil Hwang. I'm the founder of Hauzen LLP. Our firm is a 20-something person firm. It's a specialist law firm based in Hong Kong, but we cover both Hong Kong and Singapore. I'm qualified in Singapore, Hong Kong, and the UK. And I've been involved in advising on blockchain regulation, crypto regulation since 2014, actually very early on in the process, and we're recognized by Chambers Global as one of actually the only boutique Hong Kong firm to be on Chambers Global fintech list for Hong Kong. So yeah, we probably have the biggest senior team of fintech lawyers in any Hong Kong firm, and we advise across the board from transactions, tokenization, litigation, insolvency, just across the entire chain of the fintech world.
All right, so we have two heavyweights here, which is going to make us very interesting. So before we go into the specialities of what we're going to discuss, I like to situate people on the day-to-day, right? So if you can just explain me like in 2-3 minutes top, how is your day-to-day? Like, because, for example, in the asset management, a lot of people talk about asset managers, but I don't know if they truly grasp what do they really do. And from there, we take it to the legality of things, and we approach to why are things being optimized now through the chain. So Matthew, what is your day to day like?
Yeah, sure. I'm not sure how much of a 101 you want on asset management for the audience, or just specifically what I do. Um, as an asset manager, our value add is managing investments for clients, right? Bottom line is they give us their assets, they want a return on those assets, they want something back at the end of the day. So that's our day to day. My particular role and what we're really focused on at FT is tokenized money market funds. That's our major RWA, and I think it's the biggest kind of use case for RWA, but happy to be proved wrong at this point in time. So at the moment, I'm working with a lot of digital exchanges, digital platforms, distributors, how we can plug tokenized money market funds into those ecosystems. And then I'm also working a lot on our technology at Franklin Templeton. So we have been a manager that's bought fully into blockchain and tokenization. So we've built our own proprietary platform that we call the Benji technology platform that does our own tokenization for us. So I think there's not many other managers out there who've done that. I could probably name a few of our competitors, UBS, BNP. I think a lot of the asset managers who have their own bank have an engine to do their own tokenization. But yeah, so a lot of my role is also focused on the technology. How can we improve it? What features are clients looking for? Also looking across blockchains, which blockchains do we want to integrate with, and all that kind of stuff. And then also keeping an eye every day on regulations and the changing map there, and how regulations are moving across the world and where we should be or shouldn't be, and all the kind of strategy that sits in between as well. So hopefully that gives a good flavor, but yeah, a lot of variety I think is the key.
Yeah,
I
I
think it
want to
was
add
perfect.
something. I want to add something to what Matthew just said, and I'm not sure how many investors we have in the audience, but one of the things I think we work with a lot of fund managers, but the fund manager like Templeton, what it provides really is access to assets. I mean, you manage assets, and then you securitize them in a way that that makes them accessible to investors who would otherwise not have access to those things, right? So that's very, very valuable.
Absolutely, Basil.
Y-
Well put. Actually, you put it better than I did. So thank you for that.
we have the perfect definition. So you provide access to assets while you manage the investments on behalf of the investors. So that's why you're a manager of assets, something like around the lines. But I think the audience is going to have a clear definition as to what, frankly, the Templeton, because sometimes we see all these big logos and who they are, but we really don't know like who or what they truly do. And now from a legal side of things, obviously, hopefully the audience know what a lawyer does. I am also a lawyer by default. So, Vas, please, what is your day to day on the aspect of, let's say, fund manager assets? What kind of like service do you provide to them?
Well, I mean, we provide we're a financial services specialty law firm. So we serve mainly financial institutions and participants in the financial market. So we do everything within that space. But within that space, we have a subspecialty in blockchain tokenization and Web3, and so that's how I'm involved in the tokenization space. I think with respect to what we're talking about today, it's um, we help to make sure that there are legal. The idea of tokenizing assets is not a new one. Fund managers, asset managers have been making you if you buy a building, like an individual investor wanting to buy a building, you have to cough up hundreds of millions of dollars, right? But if you want to buy one piece of the building, you can't do that. You can't go to the building owner and say, I'm going to buy a small piece of the building. But what fund managers do is allow you to buy a small piece of the building by buying the entire building and breaking it up into small pieces called securities, which you can buy the securities. You buy one share, you buy 100 shares, but you buy whatever you can afford, right? So tokenization today brings an entirely new dimension to what has been it's a very established concept, a very established business. It's not a new idea, but it does leverage the technology impacts of the blockchain, of distributed ledgers, to bring a new dimensionality to this product, and the access that it gives to investors. So we help with that. I mean, among other things, we help to make sure that investors, the fund managers, are able to safely issue these tokens, and investors, when they get the tokens, can hold them safely and have the rights that they believe they should have when they bought those tokens or those shares.
Very good. Thank you very much for that great definition of the both terms. So let's go a little bit on the sauce. And for a second, Bess, I gotta say, I thought you were about to define tokenization with the breaking down and the accessibility. So we're getting there. That
Sure.
actually tokenization is not reinventing the wall. So we're gonna have to argue
We
what
should
is
talk about
actually
that.
tokenization being used for.
Yep.
So
Yep.
I entered the space in 2018, and a lot of the comments out there was like the institutionals jumping in, and I believe at the time it was more guided kind of like when are the banks gonna jump in, and I think there was a misdirection as to where the asset managers were falling into this like category, right? And then 2023 we saw the first fund managers and also frankly Templeton jumping in. So I want to understand kind of like from that point where there was an education phase of blockchain, everybody trying to understand what it was, what it was used for, to like 23 to where we are now. Why did you think Frank and Templeton decide to say, okay, fine, I'm gonna go from proof of concept to now deployment, and now I do have a money market fund on chain? Kind of like what can you tell the audience about kind of like that journey of adoption?
Yeah, I think for Franklin Templeton, we were definitely early adopters. So we first developed the technology, which let's say is like a TA registry that operates on the blockchain in 2017. From 2017, yes, it was very much a concept, very much testing things out. It was in 2021 that we first launched our first live tokenized fund using that platform and that technology. And that was in the US. So it was a mutual fund, Act 40 structured fund. And in 2021, we did the digital TA, the blockchain piece with our own technology, but we also did the off-chain record as well. So we had to prove it out, right? We wanted to make sure the concept worked. So we did the off-chain TA parallel with our blockchain TA for a couple of years till about 2023. Then we got the SSC in US, happy with, look, here's the proof, this works. It's no different. It's just a different technology. We're doing exactly the same thing. So 2023, we went to purely on-chain only with that US tokenized money market fund. So at that point, it became digitally native. There was only the on-chain record, no off-chain record, which I think is very, very important and something we're quite proud of at FT. So 2023, we kind of went very mainstream with this, with the US fund in the US. And then in 2025, we launched a Lux version of the fund. So that is a UCITS fund that is also digitally native tokenized money market fund. In 2025, we also launched a BVI, British Virgin Islands private fund, which is also digitally native tokenized money market fund. And we launched a bit later in the year, 2025, a Singapore version, which is a VCC structure in Singapore, which is also digitally native tokenized. So I've said all of that in about a minute plus, but if you look at it as a journey, it's kind of 2017 to now. And and now we kind of view this as no different to any of our other funds. A couple of years ago, there were people maybe a bit more nervous in FT. Compliance, legal would be two teams to definitely call out. But now everyone at FT is very comfortable. Compliance teams, legal teams, ops teams, everybody understands what blockchain is. Nobody has really any questions or concerns anymore. It's just, okay, what else can we do with this?
Perfect. So you just literally expanded in 1 minute 10 years of work and development, right? So that's kind of like, but that's pure efficiency. And I want to talk about a little bit later on the nativeness, right? Because a lot of people really still understand what happens when it's kind of like an adoption of the off-chain value that is brought online when it's fully on-chain. But before that, you brought a very interesting word that everybody sticks to, which is compliance, regulatory, and I think that's where Bas comes. And I would like to, since you were very early adopter in the blockchain and trying to help companies navigate this hurdle of what is blockchain, how is it adopted, or tokenization, I would like to also understand the journey for you up to today, from what you have seen previously of companies trying to adopt the technology for whatever format it is, to what you're seeing currently. Do you see the evolution? Are we going to the back, or do we still need some regulatory rails?
I think they go hand in hand, Edwin. The first of all, Franklin Templeton adopting, starting on their blockchain journey in 2017, they're definitely a very early adopter, because as we all know, who've been in this market for a while, that 2017 was really the start of the last sort of crypto cycle, if you will, right? And crypto and blockchain are not the same thing, but they're often pronounced in the same breath, right? So in the early days, from the start of Bitcoin, which is really the granddaddy of the blockchain, I think it was the premise was a really simple one. Crypto was a confidential, anonymous way to pay for things, right? For the exchange of value. People used to, we all know about people paying tips and for pizza and all that. The pizza boy who collected all his BTC, became very rich, right? And as it went on towards the later teens, the 2010s, right? 2017, 2018, we started hearing about blockchain applications for things like authenticity, tracking of logistics, and things like that, as well as, but primarily also in the financial markets. What's really kept a lot of mainstream financial institutions, and Matthew mentioned the concerns from compliance and legal, and I understand those concerns, because because of the association between blockchain and crypto. And there is a dark side of crypto. Let's not fool ourselves about that, right? There is a dark side to it. But so it tends to get linked in people's minds, blockchain and crypto. But what's happened since in the last 10 years is that as regulators caught up, and regulators do tend to be reactive rather than proactive, as they caught up and they put in more regulations, that's actually been good for financial institutions, because those are both guardrails and sort of out of bounds definition markers to tell you where you can't go, but it also tells you what you can do. So within the regulatory boundaries, it tells financial institutions, the banks, the asset managers, as long as you're meeting the rules, you can do this. So it's a stamp of approval on the activities which are regulated. And that gives a lot of confidence to legal departments, compliance departments, as well as investors and institutions that, they can go ahead and take part in the blockchain and Web3 sort of technology, that is recognized by regulations. And we've seen regulations become very developed since then, both around the world, and different countries have taken different approaches to it.
And maybe I'll just add there, if I can, it's key to point out compliance and legal structures have not really changed, to be very honest. The way compliance is still handled at the moment is just like the old way. It's all paper, it's all offline, AML, KYC. It's still done in the same way. It's only the delivery and the distribution of the assets that has changed. We still have all the controls, checks and balances in place.
Absolutely, yeah.
And that's something, in the future that may improve and change. I mean, maybe that's a topic later on, around digital IDs and stuff like that on the blockchain, which will make things even more efficient. But at the moment, what's important is all the controls, processes are the same as they were.
Well, if anything, I think
agree.
Yeah, sorry. I was just going to say that to add to what Matthew said. If anything, I think the AML, anti-money laundering sort of requirements have only gotten stricter. If you put something on the blockchain and you can meet regulators and governments' AML requirements, you're very welcome. But if not, then there's the laws around having blockchain products which don't have where you can't verify the identity of the holder have only gotten stricter.
Yep. And I think also important to point out, and something that I've said on past discussions as well, is that, even traditional finance is not the cleanest in the world, right? They've had their dirty laundry and, banks doing business here and there where they shouldn't. So nothing is perfect. And I think, on the digital asset side of things, controls, etc., remain the same. So risk is the same from our perspective.
For sure.
I completely agree. There's a saying that I'm gonna try to say in English. Let's see how well. It's like the knife has many shades, but it's the holder of the knife that decides the outcome, right? Kind of like technology is just a tool. It's not just evil, good. It has not characteristic embedded to it. And I think that was kind of like a little bit what happened in the past with blockchain and crypto and the dark side, where everybody was thrown like, no, all crypto is bad. And it's like, no, it's just the technology. It's just a tool. I think AI can be a lot worse because we've seen Terminator movies, so we know we got right? So, but now I would like to handle that. We're embedding a little bit on the technology. And Franklin Templeton as a fund manager, I mean, we're super successful at you were doing. Your structures work worldwide. You control a vast asset. I don't even know how many billions. And then you decide to embed a new technology layer. So, I mean, I understand that from a corporate side of things, kind of like that the internal compliance risk saying, hey, but if you add this technology layer, let's be careful because our whole business will break through. And that's kind of like what it took 10 years for you to go fully native on chain, correct? So I want to know the characteristics, why Franklin Templeton on that decision, took one day and said like, okay, it's time for us to first start testing how this technology works to wide on chain. Like, what is the foundation or characteristics that that as an institution was seen for them to really go fully on chain?
Yeah. Well, I think first of all, I'd say we're pretty blessed with our leadership team, starting at the top with our CEO, Jenny Johnson, Sandy Call, who's my big boss, head of innovation, they are super supportive of new technology and being innovative. There's two big challenges, which I think everyone knows for the asset management business, which is one is rising costs, and two is fees going in the other direction. So, there's a big mismatch on managers are finding it hard to make money, and also we're finding it hard to control costs. So any technology that can lean towards more efficiency, more cost savings, etc., better client experiences, better outcomes, that's something that we want to look at, right? And I think what's great at FT, and as I say, what our leadership has bought into, they realized early on that this technology is too big to ignore. I mean, if I could compare it to maybe another wave of revolution in asset management, if you think about ETFs, back in the 1990s, some managers said, ETFs, that will be a passing phase. We don't want to go into that. Don't worry about that. And then now we sit BlackRock, Vanguard, huge $1 trillion, right, all in ETFs. So I think it's important not to, sit on the sidelines when such a revolutionary technology has come about. So I think those factors combined, FT has kind of gone all in, sees this technology as solving a lot of the industry's problems, and also opens up stuff like new distribution channels, new types of investors, the next generation of investors. And I mean, I won't dive into it all yet, but the whole wallet infrastructure and what that could mean to asset management is a whole topic on its own. But
It's
yeah, I think
huge.
those are key reasons.
It's huge. Yeah. Yeah, I recall at some point when because I started my legal practice in Singapore in the late '90s. I recall the transition from paper shares. Back then, when you wanted to buy the shares of company, you get a piece of paper, a share certificate, right? And the transition up from that to electronic shares, right, where it's put into a central depository, and then your shares are shown in your electronic statement, right? So it made a huge difference to everything across the board in the operations of the securities markets, custody, settlement, payment, transactions. It just made everything faster, more efficient. Investors benefited from it, from lower costs, and I think the move into tokenization and the blockchain is going to have a similar impact on, and plus distribution as well, and the intermediary business where you mentioned, Matthew, wallets. There will come a day quite soon, I think, where people open a wallet and they can see their holdings, their ETF holdings, for example, on the blockchain in their wallet, in their blockchain wallet. Yeah.
Yes,
And something else.
absolutely.
Oh,
No,
sorry,
please,
everyone's going
please,
to add
please.
one more thing. There's something else about the blockchain is it also opens up new asset classes. So
Mm.
I think a lot of the assets will remain the same. You're just changing the way it's offered and accessed, but their blockchain is going to enable new types of asset classes as well.
Yeah.
I would like to add on that for example in 2017 here in Spain with the Security Exchange Commissioner, with the whole boom of Ethereum ICOs and the whole first movement of ICOs, the utility asset class was not existent, so they were trying to assimilate it to security because was the nearest asset class that happened to be close to that, right? And then in MiCA, it was the first time it was defined in regulation that utility became an asset class. So I completely agree with you, Matthew. Kind of like tokenized security or digital security is just a wrapper of a formal thing that already existed, and
Yep.
new assets started creating, and then we'll see the evolution from it. Maybe we'll form a new ETF that is called ETT, something that is holding a wrapper on top of tokens that we already seeing out there. So I think it's a very interesting space.
Yep.
And regarding that, I would like to ask that's because now obviously we see that evolution, kind of like it's blockchain is cost efficient, me maintaining the full ownership maybe of the whole distribution channel. I don't have to rely on intermediaries. So I can create the fees for myself, or reduce cost. So technology is always about efficiency and cost reduction, I believe, in a nutshell. But from a regulatory point of view, I would like to handle that. I would like Bas also to come in and establish, kind of like we're talking about funds, tokenized funds. And I would like for you to bring your perspective as to, is there a difference on a legal structure, or is it the same structure? What is the difference from when a client comes to you as a traditional asset manager and say like, hey, I need this fund to be a market managed fund in this jurisdiction for these accredited investors, to the same, but now in the Web3 version. I want a tokenized money market fund for these accredited investors. What is the radical difference between both formats?
I think there isn't actually a radical difference. We're really sort of putting what is fundamentally a very well established concept, the securitization of assets, onto the blockchain, onto a new sort of technology layer, which is not so new anymore at this point in time. It's regulators are getting or have already gotten comfortable around it. Regulators in the U.S. and Hong Kong have already approved a number of tokenized funds and tokenized assets for sale. The same securities laws apply to both of them. If it's a security, it's a security. You still get regulated as a security, except that instead of being through the clearing, the DTC or the clearing system, or in Hong Kong the Hong Kong clearing company, you have it on the blockchain now. So when regulators get comfortable with that, it doesn't actually look that different from your traditional funds, really. There are the changes, I think, are incremental improvements. As I mentioned, lower cost, better efficiency, faster speed, faster sort of settlement cycles. There is the I was just thinking about this, that the blockchain does have a somewhat disintermediating effect on things like custodians and so forth, intermediaries, brokers, and so forth. So I think financial institutions, but then again, financial institutions add a trust layer to all this. You don't want to be dealing with some unknown crypto sort of platform, or you want to be dealing with somebody whose good name, has reputation, is licensed, your retirement funds are safe with. So I think the financial institutions, the brands and the reputations are going to still be there, but they're going to start morphing more into sort of technology enablers for investment as blockchain becomes more commonly used for distribution and for holding and so on.
Perfect. All right. So my next question is, now that we are approaching, we brought two very close concepts, I believe: securitization and tokenization. Right. I mean, I also see that in the past, a lot of companies or the market itself, the securitization was very high level. Let's say so only accessible to few who understood it, while tokenization suddenly became world known. Right now, let's say world known in the sense that it's heavily set and adopted. And I've been in capital markets for a long time, and securitization was nowhere near the adoption as a keyword that we see tokenization. So I would like Matthew's approach as an asset manager. How could you define securitization, and how would you define tokenization, and what is the similarities between both? And yeah, thank you.
Yeah. Someone might actually have to explain the definition of securitization to me. Is that creating security off the basket of something else?
I think
or like a synthetic product?
I might maybe I should jump in here, because I think we're talking about two slightly, well, one being a subset of the other. When I talk about securitization, I meant it in a very broad sense, right? You have a company, you want to get investors, you start creating shares in a company and sell it. So that's been around since the 1800s. The turning of something which is one piece into many pieces so that many people can participate in it, right? Whereas the securitization, there's another kind of securitization which became very popular in the 1970s and still is popular today, where you banks have like a bond or loan portfolio or mortgage portfolio that they want to move off their books, or they want to move off their balance sheet. So that is a very niche market at a very high level. That tends to happen only between institutions. But I think for the audience, I think the kind of tokenization we're really talking about is more like mass market securitization or tokenization, the turning of a big asset into many small pieces that investors can then participate in, right? So that's going to be quite a separate market from the asset securitization market that institutions take part in as a way of balance sheet management, if you will. Yeah.
Thanks, Basil, for that. There is a little bit of crossover, I'm thinking, as well, which I can come to shortly. But I mean, if we look at it first in the context of a fund, so yeah, Franklin Templeton, we would pull together, let's say, equities. We buy all the different equities, we pull them in a fund structure, however that looks legally, and we sell shares of that fund, of the underlying basket of equities, to investors. So actually, all we've done with the tokenization bit is current day or traditional, you have a traditional TA who keeps a record of this guy bought 10 shares, this person bought 20 shares, this company bought 1,000 shares. And that TA will keep the record however they see fit or however the regulations allow. It could be on Excel, it could be in a TA proprietary platform somewhere, it could be on a post-it note, right? That's how they maintain the TA. All we've done is take that transfer agent register of all the shareholders, and we're keeping it as a record on the blockchain, which, as you know, cannot be changed. All of the transactions are public, where we use public blockchain. That's kind of the fundamental change. That's all we've done at the moment with our tokenization. Rather than keeping a registry of the shareholders in whatever format offline or off chain, we're keeping it solely in a record on chain, on public blockchains.
I think we just made a great definition on both terms and similarities, which is kind of like, I still believe it's kind of like a subset, but obviously one that I believe Bas really said here is mass market, right? And in that sense, I do see the trend that tokenization is trying to somehow involve retail on a non-accredited base. Kind of like they're trying to, even from logs, some structures are being found around that structure, which is kind of like, okay, it's always been used for accredited, but now I'm going to open it to non-accredited, because the definitions for accredited and non-accredited is very old. Kind of like in Europe, it's kind of like you need to have this kind of income, and based on that income, I think you know how to handle your money. But it's kind of like nowadays, everybody has access to different investment vehicles just on a click on a button, right?
Yeah.
So do you think Franklin Templeton, from that approach through tokenization, is trying to target a different investor class, or is it just trying to onboard the same investor over from a same characteristic? What is the perception here
Bit of
on
both.
the mass market? Yes.
Yeah,
please.
good question, Edwin. I would say a bit of both. We're trying to improve the experience, efficiency and cost of investing for clients we currently work with now. But you raised some good points there. So specifically for our tokenized money market funds, minimum investment amount usually used to be, even for a retail level investor, around $5,000 to $10,000. So you could not invest in our money market fund unless, let's say, the minimum was $5,000. Now with the tokenization, we accept $20. So even if you're a high school student or someone with limited savings, that's a big shift. And a big part of that is difference in the cost of running that TA. So I don't have the exact numbers in front of me, but if you imagine in the traditional sense as a TA, per transaction, the costs for you to record that transaction, the gas fees, etc., let's estimate like 80 cents per trade, right? On the blockchains, that could be tens of thousands of a cent cost. So you're going from 80 cent, and as I say, these aren't the exact numbers, but you're going from like 80 cents per trade cost down to 0.00000 whatever of a cent cost. So that's why we're able to lower the minimums from 5,000 down to $20, which then makes the fund much more accessible to to the masses.
So, and before we jump into other types of questions, I have one that is also being asked by the community, and it's like, so you're opening this from 5 to 10K to $20, which is absolutely ridiculous. The entry, and also that allows, like, through blockchain, if it was 80 cents on $20, like the cost is already too high. People would don't really say no, but it's only 80 cents. Yeah, 80 cents on how many transactions? So you have to really have the burden of the full cycle of it, right? And now you're talking about sub cent, which is possible, right? But now it comes to the point where you have this money market fund, full efficient, fully on chain, all registries there, even maybe an on chain NAVE, and all of these kind of like new engine that is working. But on the other side, you have the classic investor who has to maybe get convinced. So, what is the selling point for this new, or the traditional investor, to jump into this new technology without the reticence saying, "Oh, but crypto is bad"? Like, how do you break that cycle here?
I think it depends on the client and the use case for the asset, etc. I mean, I can give you some obvious ones that we have now. So one feature that we are getting a patent as we speak on is intraday yield. So for our tokenized money market funds now, to the second in the day, if Edwin transfers the tokens to Basil at midday, Basil starts earning the interest from midday. And we can split the income throughout the day, and that can be as many transfers as you want. The token could be transferred 100 times in the day, and the interest will be split between those 100 different wallets for that one day. So
Yeah, that
that
in
kind
itself
of,
is, sorry, I was just saying, Matthew, just off the top of my head, I mean, that in itself presents new trading sort of strategies, opportunities for new trading strategies, right? Just that alone.
exactly. And let's
Yeah.
look at one of the big use cases for tokenized money market funds at the moment: collateral.
Mhm.
So if you're now saying when people move collateral to each other, or margin calls are made and tokens are moving around, the interest is moving, the ability to earn the interest is moving instantly as well with those transfers. That's massive.
Mhm. Yes,
So
massive.
for those people, and that's where I would say at the moment, it's easier to convince people about the benefits of investments in tokenized format when the asset has high frequency of trading, or the
Yeah.
asset is hard to access. If there is an asset moving back and forth, 100, 200 times a day, then tokenization is really going to benefit. If it's an asset that usually is hard to get into because of large minimums, because of the structure of it, it's not easy for investors to access, then tokenization will help. To be very honest, if you're talking about a global equity fund that someone's going to invest in and hold it for 10 years, I don't think tokenization is a big benefit just yet. Because just you can invest in it one day earlier, the settlement cycle is one day earlier, but you're just going to hold it for 10 years anyway. I don't think tokenization is so urgent. It still can help eventually, but for me, the tokenization and convincing people use cases here and now is based on those.
Yeah, I
Yeah,
mean, there's an entire different sort of there's so many different categories, right? Because we're right now we're talking about publicly traded securities. I think, Edwin, you're asking about like what would convince a classical investor to jump in. Matthew's mentioned one of them where the you take something like Berkshire Hathaway, for example, right? You want to buy one share, cost you a few $1,000s. What if you want to buy 1/10 of one share? Somebody can tokenize it. You tokenize that share, and then you sell fragments of it, right? So you can have, as a retail investor, you could take part in shares which are very big amounts per share, but taking part in a fraction of that share only. Where institutions are concerned, and even banks are concerned, for example, the debt side of things, you could tokenize loans, you could syndicate loans through the blockchain. You could take part in private equity single asset transactions through the blockchain by tokenizing the asset, for example. So there's a lot of possibilities there, and the amount of work that goes into transferring a non-liquid asset. There's a lot of work that goes into it. You want to sell a syndicated bank book, for example, to another bank. there's a lot of legal and technical and operational work that goes into that, right? You can remove a lot of that if you put it on a blockchain and it's just transfer the book out a lot more easily over the blockchain, for example.
This brings an just to put a little bit of a glance here, because we could talk about this for ages. What is the
Yeah.
structure, which is
Yeah.
24/7 T0, but not T0 intraday, intrasecond. Like, this is, some institutions out there are not ready to provide even liquidity around it, because the settlement just not became kind of like, oh, I'm going to finance myself for the next 2 days so I can repay. That is kind of like, no, you give it to me this exact second. And that's just kind of like, I think one of the things that really amazes me, kind of like at the speed of things that we're moving, people take them for granted, but they don't understand on the classic structures, nothing ever happens like that, And just to put it as a conception, here in Europe, it became a big problem when, through law, it was provided that all transactions or transfer between retail had to happen and settle same day. And instant settlement, kind of like plus 1 minute or plus 1 hour, depends. And a lot of banks complain on that. It's like, you're putting a lot of liquidity pressure on me, where I'm supposed to be playing around. But the one, if kind of like the leverage that we're playing here on the instant settlement is something that really, I think it's gonna have to be seen in the couple of next months and years, because there's a couple of, I believe, parts of the whole structure that are not ready for that kind of like instant settlement, if I may. So I just wanted to bring that, because for me, that's something that really kind of like excites me, but I know there's something to be worried there about. But on the other side,
Edwin,
sorry, go
Edwin,
ahead.
I just want to bring up one point. You brought up, because in every settlement cycle, there's two sides to the equation, right? There's the transfer of the title to the asset, but there's also the payment for the asset, right? And I think the title transfer on the blockchain can happen very quickly. But what about the payment? What are we talking? Because we don't have instant payment right now in fiat currencies, right? And the status of stable coins everywhere around the world is still, by and large, still there's a question mark over it, right? So how are people going to pay for these? If you're settling right now and I'm supposed to get my money right now, how am I? Yeah, I can send the asset to you right now with blockchain. It takes a few seconds depending on which chain you're using. But how am I going to get my money right away? Are you going to pay me in stable coins? And is that legal for institutions to accept? There's still a question mark over that. So I think we're still missing one part of the equation.
You've hit the bullseye there, Basil. That's our big challenge at the moment. How does the cash move on chain to match the same speed? Whether that be stable coins, tokenized deposits, that needs to be brought on chain. And then also as a manager, we have a challenge of NAV production. We have a fund admin agent, usually from one of the large banks, who's producing our NAV. But if the NAV of a fund can't be produced until T+1, we can't settle the subscriptions until we get the price and the NAV in. So, the whole industry in financial services is a big aircraft carrier, and there's a lot of people that need to work to, turn that ship around.
A lot of
so we do exactly. Yeah. But I mean, maybe we're jumping off topic, Edwin. So we should probably come back to you and the questions you want to ask.
This is for webinar 2.
Yeah.
No, but please, Matthew, please finish your train of thought.
Well, I was just going to say, the key to really getting to the benefits is the whole ecosystem needs to be on chain. So we as a fund, so the tokenized money market fund, we need to buy tokenized treasuries, not just normal treasuries. We need to buy tokenized treasuries. Then investor gives us a stable coin, the fund accepts the stable coin, we give the stable coin to our portfolio managers. The portfolio managers can use the stable coin to pay for treasuries, and then the whole process can be done in, I don't know, maybe ambitious to say minutes, but yeah, there's a journey to get to. We're only scratching the surface at the moment.
Absolutely. So just before we go into the closing statements, I have a question for you, because now it's clear that the nature of these tokenized funds and whatnot. What would you say to somebody as the selling point? Let's say I come as a classic fund manager, and you say like, hey, Edwin, have you ever thought about the tokenized version of what you're trying to build? Is it something you actively engage with, or you just still kind of like, okay, no, I'm gonna wait? What is your vision here? Do you see this as the next that statement that actually capital markets will run on blockchain, or is it more like, okay, let's see how it plays out? Right now, I'm not pushing too much this kind of product.
Yeah, I think as Matthew mentioned, taking the aircraft carrier sort of analogy, aircraft carrier, it does not travel alone, right? It needs a lot of support ships. It needs supply ships. It's logistically, it needs a lot of support, and the financial system, just let's not talk about the financial system. Just the asset management market is huge. And that's just one part of the financial system. We're not even talking about traditional banking, the banks, or payment systems, or all the other things that comprise the insurance and all that, all the other financing of ships and infrastructure. That's huge. The financial system is huge. Let's stick to the asset management system. What would convince an asset manager or fund manager to come on board? I think it's the things I can think of would be safety/security, faster / more efficient AML. AML is a big issue for fund managers. Let's not deny that, especially if you're in the you're dealing with new clients, for example, or your private equity or venture capital sort of fund manager, and costs. You could lower the cost basis, your sort of cost ratio, expense ratio for your fund entirely, and make your fund more attractive to investors if you can offer lower costs, right, to investors. But then the ecosystem needs to support it. One of the things was the payment for sort of on-chain sort of payment systems, which I don't think are 100% there yet, and it will come, but we're not there yet right now. And the other one is having the technology partners, and I think Matthew mentioned you have your in-house technology. Brickken is a technology provider for that, and provides the solutions for that. But having the right technology partners is very important. Among many other things that I can think of, right? Custody, asset custody, for example, who's going to be holding the underlying, upon which the tokens are issued, who's holding that, depending on what the underlying is. You have to have custody partners.
Yeah.
Thank
you for that. And just to put that as an analogy, us being a software provider, we're evolving into custodian and everything. So our product that was kind of like this, it started becoming so big just because there's so many models and players that you have to connect with, that the infrastructure. And that's why I kind of like when some people say like, oh yeah, secondary market, primary market. And I was like, yeah, why don't you just create the whole new market tokenization? You know what you're trying to build? Like the mammoth. That like
it is a mammoth.
It's crazy. So best is kind of like, and this is what I'm seeing now in the space and talking about the polls and everything, kind of like it's finally segmenting, right? Because one company, except like the huge ones like the Franklin Templeton, may arise and build the whole flow, but other ones we need to worry on one specific part of the market, right? So suppliers such as software, now we exist. Now we need liquidity, so I'm super happy when people are trying to build like this called RWA bolts, the collateralization, just to put the wheel to move, because if not, you just have a bunch of supply that is stuck on the market. So now we're seeing how it's moving along the funnel. So it's something that I really want to bring to people, because the complexity of building something like this, it's not simple. It's not just I create an asset. Yeah, you don't need to. You just sign a paper. You just created an asset. You don't need technology to create an asset. Correct? Okay. Now, as we last 5 minutes, I'm gonna ask a last question, and it's not gonna be the usual. Oh, what do you see in 5 years? What do you think it's needed as what do you expect in the coming time for this to become more of a natural thing, as a standardization? What are your players or models or technologies that you need for this to become a standard play?
Wow. I think it depends on which jurisdiction.
It's a high level, right? It's like everybody's like, this is not a test, guys.
How long have we got left?
5 hours.
Yeah.
Or 5 minutes. We got 5 minutes.
Yeah.
You go for Matthew.
Yeah, well, I think Basil touched on a lot of it earlier. You know, there's a lot of players in the ecosystem that all need to bring their services and functions and products and stuff on chain, because everything needs to be on chain to really have a holistic benefit. So that is happening. You know, some of the asset managers have been first to move. I think a lot more are following. Our peers are definitely getting involved. Everyone's now sensing, hold on, we're going to miss out on something if we're not ready to plug into this wallet infrastructure. Then we're gonna miss out on something big. The banks obviously under a lot more scrutiny and regulations than we are, so they've been a little bit slower. You know, even adopting stuff like public blockchains over private, etc. But I think we're starting to see the banks move. Without naming names, I know a lot of them are going to start to move to public blockchains this year. So I think that's going to be a good shift. All of these players saying, okay, yeah, we agree, let's do this on chain. I think another big factor, just to add, is going to be the change in generational wealth. Because as money starts to move down from one generation to another, the new generation who already trade crypto maybe and you know, altcoins and whatever else are maybe very familiar with wallet structures already.
Yeah,
And if you
absolutely
can
right.
go to that, yeah, and if you can go to that generation and say, look, next to your crypto and whatever inside your wallet, you can also hold our funds, our ETFs. You can buy us part of a stadium. You can buy
Yeah.
part of sports teams. We'll give you an investment in, okay, I'm not going to name any specific sports clubs, but you know, we can offer all these types of investments. That is all going to add to the pickup of this kind of technology. And then you start getting into stuff like rewards and personalized investing, and invest in this fund and we'll give you tickets to this concert or this soccer match, or you know, whatever it is. That all of that stuff is going to add into the popularity.
I think the big one for me is with Templeton and you know, sort of managers of funds, especially mutual funds, for example, but also private equity funds and other sorts of funds. It in a sense, I don't mean to discount anything, you know, because Matthew, you've done a fabulous job, 10 years of work there, all that. But in a sense, the benefit you have is not having to deal with external parties like stock exchanges, because you're not publicly traded. I assume, I agree. You know, if you're running an ETF, yeah, it will be publicly traded. But if you got a tokenized ETF, for example, then you got to bring in the stock exchanges, and that's a whole different set of regulations altogether. I think in the US they're a little bit more open-minded about this. In Hong Kong, which is Asia's biggest capital market, for example, you know, there is a struggle with you know, I think it'll take a while before we can persuade the stock exchange to say, hey, you know, we want a fully tokenized public offering, or at least we want to tokenize part of this of this listing, right, and just trade entirely through the blockchain on it, right? So the exchanges need to get comfortable with it and allow the trading of you know, token native, blockchain native sorts of securities. Yeah, so that's a big one.
Perfect. So we just reached the end of this webinar. I can only thank you both for this great conversation, and ask everybody who's listening to this or actually seeing it, please add Matthew and Bas. I think they have a lot more to say, and a lot of great expertise here being thrown. So thank you very much, everybody, for joining us on today. And Matthew, Bas, once again, thank you from the whole team in Brickken and everybody who's listening, because I think this was super insightful. Thank you.
Thank you very much. Thank you both.
Thank you, guys. Appreciate it. Thank you.
Bye-bye.
Bye.